All right, welcome. Today we're going to put on our detective hats and dive into the world of accounting. We're on a mission to demystify some of the most common errors that can lurk in a company's books. And, more importantly, we'll figure out how to hunt them down and set things right.
So let me kick things off with a question for you. If your debits equal your credits and everything on your trial balance lines up perfectly, does that mean your books are 100% accurate, no mistakes? It's a common belief, but is it actually true? Well, here's the spoiler. The answer is a big, resounding no. Believe it or not, a trial balance that looks perfect on the surface can still be hiding some pretty significant errors. So today, we're going to investigate exactly how that's even possible. And this brings us to what I like to call the balanced book mystery. It's this fascinating puzzle of how a set of accounts can look completely in order, totally balanced, while some serious mistakes are hiding just beneath the surface.
So, what are we actually hunting for? Well, accounting errors are basically just mistakes that can pop up anywhere in the bookkeeping process. Now, they're not usually malicious or anything. Most of the time, they're just simple oversights, maybe a lack of knowledge or a tiny clerical slip-up. But don't let that fool you. Their impact can be massive.
Okay, now that we've set the scene, it's time to meet our usual suspects. We're going to look at the main types of errors that are slick enough to sneak right past a trial balance without setting off any alarms. First up, we have the error of omission. I call this one the silent culprit because the transaction just disappears. It never gets recorded in the first place, so it leaves behind no evidence, no trace, and most importantly, no imbalance in the books. For example, let's say you make a cash sale but totally forget to record it. Well, that means there's no debit to the cash account and no credit to the sales account. Since both sides of the transaction are just gone, the books stay perfectly balanced. It's like the sale never even happened. Sneaky, right? Next on the list is the error of commission. This is like a classic case of mistaken identity. The transaction gets recorded, yep, but the details are just plain wrong. Maybe you type in the wrong amount, or you post it to a completely unrelated account by accident. And this is where things get really tricky. Say you paid 5,000 rupees in rent, but you accidentally record it as 500. As long as you post that same wrong amount to both the debit and credit side, the trial balance won't know the difference. The numbers are wrong, but they're consistently wrong, so it all balances out. Our third suspect is the error of principle. This one happens when a fundamental rule of accounting gets broken. For instance, treating an asset as if it were an expense. You've recorded the right amount of money, but you've classified it in a way that's completely against the rules. And here's a brilliant example of that. Buying a machine is a capital expenditure. It's an asset for your business. But if you record it as just a regular business expense, you still got a debit and a credit. The numbers balance perfectly, but now your financial statements are telling a very misleading story. Then we've got compensating errors. Oh, these are the true masters of the cover-up. This is when two or more totally separate mistakes are made, and just by sheer coincidence, they manage to cancel each other out perfectly. So the whole point here is that one error perfectly hides another one. Imagine you overstate your sales account by 1,000 rupees. Bad. But then you also overstate your rent expense by the exact same amount. The two mistakes completely offset each other, and your trial balance looks totally fine. And our final suspect, the error of duplication. This one is pretty simple, but you'd be surprised how common it is. It's exactly what it sounds like. A single transaction gets accidentally recorded twice, or maybe even more times. Think about it. If you record a salary payment correctly and then you do the exact same entry again, you've just doubled the debits and doubled the credits. Your trial balance sees no problem at all because both sides were duplicated. But in reality, your expenses are now completely inflated. Okay, so we've identified all the criminals. Now, how do we bring them to justice? Let's open up the correction playbook and look at the tools and techniques we can use to fix these sneaky errors. There are really two main paths you can take here. If your trial balance doesn't agree, well, that's a huge clue. In that case, you'll probably use a special tool called a suspense account. But if it does agree, like with all those tricky errors we just talked about, you have to find them and correct them directly using journal entries. So what in the world is this suspense account? The best way to think about it is like a temporary holding cell. When your debits and credits just don't match, you stick the difference in this account to force a balance. It buys you some time to go investigate and find the real source of the problem. The process is pretty straightforward. First, you spot the imbalance. Second, you just move that difference over to the suspense account to get things balanced for the time being. Then the real detective work starts. As you find each error, you make a correction, and that reduces the balance in the suspense account. The goal? Keep digging until that suspense account balance is back to zero. So, why does all this financial detective work really matter? Well, because the consequences of just letting these errors sit there uncorrected can be pretty serious. Leaving these mistakes in the books can totally distort a company's financial reality. It can make a business look way more or way less profitable than it actually is. It can misrepresent what you own and what you owe, and ultimately, it can lead management to make really bad decisions based on faulty information.
And this really is the ultimate goal. The entire point of accounting is to provide a true and fair view of a company's financial health. So, correcting these errors isn't just about making numbers add up, it's about restoring integrity and trust in those financial statements.
So, to wrap things up, here are a few key takeaways. First, and this is the big one, never, ever assume a balanced trial balance means a clean bill of health. Second, pay extra close attention to those errors of principle. They're subtle, but they're dangerous. And finally, make sure you understand how to use a suspense account correctly. It's a tool for investigation, not a permanent fix. And with that, our investigation comes to a close. I'll just leave you with this one question to think about. After seeing how easily major errors can hide in plain sight, what's one financial truth in your own work, or even in your personal life, that might be worth taking a second look at? Thanks for joining me.